Hello, and welcome to Servitization Shorts. I'm your host, Patrick McGowan, CEO and founder of the Service Design Group, and I'm excited to have Jimmy here with me today.
I'm Jimmy Bynum. I'm the founder and CEO of Garde Solutions. Garde Solutions is a company that partners with manufacturers and large distributors, primarily in the business-to-business or industrial equipment space. And what we do with our clients is we work with them on their product lifecycle solutions. That would include warranty, extended warranty, maintenance agreements, and also some traditional insurance programs such as physical damage insurance. We've got an expertise around setting up captive insurance companies. Been doing that since late 2014. Prior to that, I spent 12 years at Caterpillar, specifically within Caterpillar Financial Services, the insurance group, which is the captive insurance and extended warranty division of Caterpillar. Been active in the industry from being one of the founders of the Global Warranty and Service Contract Association a few years back, and then also sat on the Texas Captive Insurance Association board.
Why don't we start with your take on advanced services, what advanced services means to you, and then we'll bridge over into the union between advanced services and your specialties around captive insurance models.
There's rumor that the first extended warranty was way back when the hand crank washing machine was developed. But I think what people are finding now, companies that buy assets to utilize in their business, they're looking at it in a different model. They're really looking for, what does it cost me with earth moving, for example? What does it cost me to move a pile of dirt versus, how much does this machine cost? How long am I going to own it? The whole integrated approach to my maintenance, my data and analytics, how productive is my piece of equipment? Looking at the Internet of Things, most of the equipment that we deal with is connected in some way to the internet, either through distance monitoring, or almost everything that we look at has a plug-in where when it comes in for service, they plug in and they can evaluate what's going on with the piece of equipment. Advanced services to me really encompasses not only the product sale, but how is it serviced and supported after the sale for the owner of it. And they look beyond just, is this the lowest cost piece of equipment versus the next company offering something that's a little more expensive. I think people really are looking for a comprehensive solution to help them focus on what they do. So if you're an auto repair shop and your job is to repair automobiles, we have a relationship with Bosch. And Bosch developed a tool called Robin Air. And if your air conditioner fails in your car, you plug in a Robin Air, they diagnose what's going on. And so the repair shop, their business is to repair vehicles. And if that Robin Air device is operating appropriately and as it should be, then they don't have to worry about it. They can do their job. The same thing with a guy driving a tractor. His job is to move a pile of dirt or dig a hole. And he wants to be able to focus on moving that dirt or digging that hole and not, is it time for me to do maintenance? He wants to be notified of that. He wants his dealer partner to show up and squirt the grease in the lube ports and change the oil and maintain it for him. It really is more of a comprehensive way to look at owning, operating, and monetizing your tools. And Cat Financial's got a very interesting story. The founder of Cat Financial, Jim Beard, he was a Harvard guy and working in Caterpillar, and he went to the board of directors and said, I think we need to form a finance company. And the board of directors initially turned him down. There was sort of this negative connotation about having to loan people money. So that evolution of transactional financing of loans, and then those loans turned into leases. They pay a monthly lease payment, which is fully deductible, as an expense, as opposed to capitalizing it on their balance sheet and amortizing it or depreciating it over the life of the asset. So it became a step closer to, I don't want to own the assets. I just want to use the assets to do my job. All sorts of companies said, well, gosh, that's a great model. GE grew out of that entire model. They became the third-party lender, leaser service model. DLL, another great finance company that supports a lot of industrial companies. They look at, this closed loop of owning an asset, utilizing it, having the maintenance there, and observing that that asset has a higher value, residual value over the life of it if it's properly maintained and utilized. And the Internet of Things has really brought us to the next wave, which is understanding what's going on with that piece of equipment while it's being utilized. as opposed to just throwing it out there and having folks try to figure it out.
But I'd like to get your thoughts on the risk profile here.
I'm a big believer that everything starts with your strategies. If you work for XYZ company and XYZ company makes widgets, and XYZ CEO sets a vision, we want to increase our EBITDA, or we want to have the highest customer loyalty. There's certain strategic goals that everybody sets. And when it comes to managing risk, it really needs to start with what are the corporate objectives. And I pretty much simplify it. There's 3 ways to manage risk when you're looking at any kind of risk. You can leave that risk on your balance sheet. Warranty is one example of risk. You sell a piece of equipment, and if it comes with a limited warranty, which all products do, you sort of provision, put a little money over here on the side and wait for something to fail. And when it fails, you have this money on the side to pay for those failures. So that's the sort of leave it on your balance sheet method. Some would call that a self-insurance model. The other model is, I'm not real sure about how to manage risk, so I need to find a third-party insurance company that I can write a check to, pay them premium, and when something happens, I get reimbursed from that insurance company. And you can insure all sorts of risks. I mean, cyber risk, warranty risk, mechanical breakdown, physical damage for fire, theft, and that kind of thing. You can insure all those kind of risks. Or you can set up a captive insurance company. And that's one of my, probably favorite solutions, because if you're big enough to be in the business of making equipment and you have a decent balance sheet, having a captive insurance company makes you a very sophisticated risk manager. You're now running an insurance company. And when you are running an insurance company, you don't forego or sever your relationships with your big insurance company. You're just managing risks that you're very comfortable with. Our philosophy is make a little bit of money on the extended warranty, but really use it as a tool to gather more data and reliability and quality information over a longer period of time and build customer loyalty. And captive is really my favorite solution. Captive or balance sheet. Nothing against the third-party insurance companies, but you pay a premium and they make a profit, and you should be owning your product quality when it comes to that.
So I'd love you to unpack captive insurance, a term when you're unfamiliar with it. At least for me, it almost sounds like, is that a good thing or a bad thing?
Yeah.
Tell us why it is your preferred of the 3 risk management strategies.
So in simple terms, a captive insurance company is an insurance company that's established to insure the risks of affiliated companies. So if you think about a $1 billion revenue company that is a holding company strategy, and within that holding company, maybe they have a manufacturing arm, maybe they have a distribution arm, and maybe they have an international arm. But that holding company has various risks within those businesses under their holding company that they can manage. Everybody, they all have deductibles. If you have an accident in your car, you're paying the first $500 or $1,000. Corporations take these deductibles to the next level. Captive insurance can insure that deductible layer. So rather than paying premium to an insurance company, you can raise your deductible and you can set up an insurance company that you own and control, and you pay premiums into that captive. And so rather than having a balance sheet that you have to encumber with sort of provisions for workers' comp claims or warranty claims or fire claims or flood claims, you can buy an insurance policy. And so you're paying insurance premiums into a captive insurance company that's part of your network of corporate holdings, and you're able to retain the profits. You also retain the losses. So if you pay out a lot of claims, then your insurance company is not going to be profitable. But it makes you a much more sophisticated risk manager. And then when you enter into conversations with your broker, you understand the risks that you're talking about much better. So a captive insurance company is just that. It's an insurance company that you set up, and it insures your own risks of your own businesses.
Kind of from a strategic opportunity standpoint. And you really do, I think, need to own this risk stance, this insurance stance in-house.
Well, I've made an argument that a dealer, let's just use equipment dealers as an example, because it's a model that you can kind of relate your own business to. So if you're an equipment dealer, whether it's farm equipment or construction equipment, it doesn't matter. you are the one that has a relationship with the end user, whether it's Johnny Backhoe or Johnny Farmer. They're coming to your dealer and they're saying, hey, I trust you. You are going to be the person I'm going to write you, $1 million to, $20 million check for all my equipment, and you're going to repair it also. So they're kind of a trusted advisor and a trusted resource. That dealer understands what is going to fail, when it's going to fail, how much it's going to cost. So if you walk out into the shop of any repair shop and you ask a mechanic that's been around a long, you say, of all the models that y'all sell, whatever they are, which ones do you think are the most reliable? Which ones are the ones that have challenges? That mechanic can say, these are really good, but about 3,000 hours and about 2.5 years, we're going to see these seals start to fail and it's going to leak, which is going to cause this problem. And if not addressed, could be really serious. Taking that risk and giving it to a third-party insurance company is not smart, because that dealer understands the risk really well. They've got years and years of experience, and so they should be retaining that risk. And for a manufacturer, it's even more important for a manufacturer to sit back and say, this is our product, we're standing behind it. If we bring in a third-party insurance company to underwrite warranty risk or extended warranty risk, we're really turning over our dirty laundry, our quality shortcomings, to a third party. Most insurance companies reinsure their risk. And so not only are you sharing your dirty laundry with the company that's underwriting it, the reinsurance market now knows, that, hey, my widgets are not that great. We've had some bad experience. And those companies they do a good job of managing risk, but they also make a profit. And if you place that risk through a broker, there's a broker risk, broker profit layer. Then there's the underwriting profit layer. It's just not a good model. I think if you're in the manufacturing business, you should stand behind your product risk 100%, because it's going to cost you more if you don't.
Here, I feel like this is a very tangible path one could go down that has clear business upside. How do you get started?
I'm a photographer, and so I use the analogy of photography. I like to put my wide angle landscape lens on, step back and say, what's going on in your company? Are you growing your dealer network? Do you have a quality issue somewhere in your portfolio of products? When you set the pricing on your extended warranty, what method did you use? How many layers of sort of incentives are being doled out to the dealers and the salesmen and blah, blah, blah on how you're driving that? And then let me hear what your CEO is saying to the shareholders about where they're taking the company. Are they talking about, we're going to strengthen our balance sheet, we're going to increase our EPS? What are the main goals from a financial and operational standpoint? And then once you kind of get around that strategic vision of what the company is doing, then the next step is, okay, let's understand your product sales process. How are you selling it? How are you servicing it? Are your servicers integrated through your dealer network? And then from which risk platform do you use? That's going to be driven out of the strategic plans. If the company has a decent balance sheet, we would look at that as, maybe they would be good for a captive insurance company. Maybe they should just leave it on their balance sheet. Or maybe they do need a third-party insurance company for a part of the risk. So we look at the whole picture and then come back and say, based on your strategic direction, you should leave it on your balance sheet. We need to partner with a third-party insurance company, or we need to set up a captive insurance company.
As with most transformative or potentially transformative initiatives, it does start with, you need to know what your business outcome is. Are you trying to grow earnings per share? Are you trying to grow profit margins? What are you up to? What's your strategic vision? And then this risk management can be aligned in many ways.
You can't just say, I want to deliver, hole digging capability to you, because there's a whole lot of stuff that happens behind the scenes. It's really more complicated than a lot of people think. You have to start with the customer. If you're not looking at the end user, and the end user can be the guy that needs the hole in the ground, but how's he going to get it? So the customer, in my mind, is the contractor that's going to do that. And how can he facilitate that? The lessons learned, I would say, are pick what it is you're going to do, but understand what are the stepping stones to get you there, from the assets required to get it there, the costs, and how are you going to deliver it? A lot of times you'll have a really smart person in an organization that says, hey, we need to do this, but they're looking kind of myopically with a microscope, and they're not understanding, what is my boss's strategic goal for our division? What is the group president's goal for his division? What is the CEO saying for our strategic plan? And how does this thing that I'm thinking of fit in that? And what are all the processes, people that need to be put in place to do that?
Well, this has been really good deep dive into some topics I think a lot of people maybe don't immediately think of in this servitization space. So I appreciate you taking the time with me today.
You bet. It was great. Thanks for